Hello everyone, welcome to this trade management mini session. Today we're going to create an example trading plan on short put verticals together. My name is Barbara Armstrong. I'm a coach with Charles Schwab and a senior manager. I invite you to follow me both on LinkedIn and on X, my handle on X at Barb Armstrong CS. Before we get into things, I just want to remind everyone that options carry a high level of risk and aren't suitable for all investors. We're using the paperMoney software application on the thinkorswim desktop platform for our example today. Looks like, smells like, feels like real money, but it's not. But it's a great place to practice and hone your skills before you consider trading a strategy like this in your live account. Know that the paperMoney platform will never assign a short option early. That can happen in a live account. Okay, so I just want to be sure that you're aware of those things. Now let's go and bring up our shell of a Word document. And I've just put our 5 categories in here. And these categories, include, with our trading plan, what to buy or what to trade, when to trade it, how much to trade or our position sizing, when to sell, and our daily routines. Okay, so what to buy? If we're looking at a short put vertical, this is a bullish to neutral strategy. So when we're looking at what to buy, we're looking for a stock that's uptrending. And if we're really trying to go with the flow, we put on our checklist that we also want it to be in a sector that's uptrending. And we'd like to also see that the market is uptrending. And so, check, check, check. That's what we're looking for, those 3 things. We also want stocks that trade high volume. And so you might say, well, what's high volume? You might say, well, we want it to be trading 1 million shares per day or higher. So that might be a way to define our high volume. And then we might say, when we want stocks with high volume, because we know if we get stocks with high volume, that we're more likely to find options that trade high volume, where the open interest is, ideally thousands of contracts, but we might say for our minimum, we want it to be at least 20 times the number of contracts that we're going to trade. So that might be our low bar. And we might also say, well, with the options, we want the bid-ask spread to be tight. And by that, we might mean, we don't want the bid and the ask. If one option's $5, the bid is $5. We don't want the ask to be more than $5.50. So we might say, well, we want it to be at least, ideally, pennies apart, but no more than 10%. So we want it to be the bid-ask spread to be less than 10%. We might also say we'd like the delta, and on the put side, that's going to be a negative number, to be in that 20 to 40 range. Now, others might not look so much at delta. They might be just looking at the chart and saying, I want this to be below a support level. But that is something that some might include in their plan. When it comes to expiration dates, so how long do you want to be in the range in this trade? You might say, well, maybe that 20 to 50 days, that kind of range. And you might also have a target for return on risk. You might say, hey, if I'm risking some money here, I want a minimum return of, say, 20%. And others might say, well, I want a minimum of 20%. And then if I'm going to be in this trade for 40 days, I want at least a 40% return. So you might say, like, I want a minimum of 1% per day to expiration, as a way of trying to create an apples to apples comparison. If you wanted to compare a 20-day to expiration and a 40-day. And then others might do this as an earnings trade, and others might say, this is one of my rules, is that I want to avoid trading over earnings or a big announcement like an FDA approval on a drug or a big product announcement. because there can be volatility and a lot of gapping up or down. If it gaps up, we're golden. If it gaps down, then you might be at your max loss. So if you want to avoid that kind of anxiety, you might just say, well, I know that I'm missing out on the volatility, which might make my credit higher, but I'm willing to do that to avoid a potential gap down that would take me to my max loss. Now, when are we going to trade this? And so this is for, the people that like technical analysis. This is a component of your trading plan. And you're saying, well, I'm looking for a bullish entry. And a bullish entry, that might include, and this isn't, an all-inclusive list, but you might say, I'm looking for something that is breaking out above a resistance line. And it could be a diagonal resistance line. It could be a horizontal line with a cup and handle pattern, or a double bottom, or an inverted head and shoulders. If all of these are new terms, you may want to check out the Getting Started with Technical Analysis class. We might also say, well, I'm looking for something that's bouncing off a support level. Or I'm looking for a bull flag with a close above the high of the low day. Now, I'm assuming that you're familiar basically with this strategy. And if not, you may want to go and look this up in the Getting Started with Options series, the one specifically on short put verticals. And I know over the years I've recorded many of those. So that's not an exhaustive list, but it's enough to kind of wet your whistle. And then when we look at position sizing, some might say, okay, well, I'm going to base this on one max loss. If the trade went against me and I took my max theoretical loss, I'm going to base my position size on that. And then they might say, well, if I'm also going to base it on my account value. So, and so that might be 1% of your account value. If you had a $100,000 account, you might say, I'm willing to risk 1,000, or you might say, I'm willing to take 2%, which is what we've done in our Trading a Smaller Account. Or if you had $1 million account, you might say, I'm only willing to risk half of 1% of the account value. Or you might pick a number, or you might say on a quarterly basis, if I had 100,000 to start, I am willing to risk half of 1%. So you might say, I want my max loss to be $500 per trade. And then you might want to just ask yourself, if I had 5 trades in a row go wrong and take a max loss, would I be okay? And so that's our position sizing. Now, when do we exit? Well, we might say, okay, given things go according to plan, I am going to exit at 80% of my max gain. So if I sold this credit spread, this short put vertical for $2, when it's worth 40 cents, I'm going to buy it back. Or you might say, my number's 75% or 90%, you can make it whatever you want. Some might say, I'm choosing to let it expire worthless. In this example trading plan, that isn't our choice. We're also, we might say, we want to exit in all cases prior to expiration. And this avoids having the potential issue of something close in between the strikes, where the short strike is exercised and the long strike is not. And then you're at risk for greater than your max loss. So if we exit prior to expiration, we avoid that potential problem. Okay. And then if the trade, if the stock breaks below that support level that we expected to hold, we might say, I'm going to do nothing. I position size for max loss. If it comes back, I'm good. If not, I'm going to leave it alone. Some might exit half the position. If you did 10 contracts, you might say, I'm going to exit 5 and then keep an eye on it. Or some might say, hey, I'm going to exit the entire position. I expected this to hold and it hasn't. So it hasn't gone according to plan. And if you've just placed the trade and something extraordinary happens, you may well not be at max loss. And so you can exit the entire position and get out before it becomes more painful. And then with respect to daily routine, you might say, well, as part of my daily routine, I'm going to monitor my current positions, because if something's at like 70 or 75% and I'm close to 80 and I've only been in the trade for a week and I expected to be in it for 3 or 4, maybe I choose to exit. Or maybe if it looks like it's about to start pulling back and I'm at 60 or 70%, I might choose to exit. So you're going to monitor your current positions, both if they're going for you or if they're not. And then you might say, I'm also going to look for new trade opportunities. And so there, in a nutshell, is our shell of a plan. So let's go out now to the thinkorswim platform. I brought up Marvell. So Marvell is a tech stock. Is it uptrending? Well, yes. Could one argue that it set up a bit of a bull flag pattern? Perhaps. If so, do we have a close above the high of the low day? Well, yesterday was the low day. Wednesday was the low day. It closed above that and, is continuing to trend up. So stock is uptrending. Is the sector uptrending? Well, I brought up our sectors here. Here's the tech sector. It has been dramatically uptrending, pulled back. Some might argue that looks like a bull flag and is moving to the upside again. So stock, sector, how about the market? Well, if we bring up the SPX, we can see it hit a new all-time high just a week or so ago, pulled back for a few days, and is moving again to the upside. So trend, sector, stock, check. So if we now come back to Marvell and say, okay, well, does it trade more than 1 million shares a day? So we're going to come to the trade tab. We're at 31 million shares for the day today. If we look at our options, and this is on the put side, and if we looked at where might we sell our strike? Well, if we say, here's our recent support here around the 250 level, even though it's trading at 286, could we sell a put at 250 and then maybe something at 245 or 240 below it? And as long as it stays above it, we would have a successful trade. If it goes sideways, we have a successful trade. We even have $36 worth of wiggle room here if we're able to get enough premium at the 250 level. And so if we come out here and we say, okay, we're going to come to this July 17th, that's 35 days out. So that's between 20 and 50. We're going to come to that 250 strike. And on the monthlies, these are $10 wide. So do we have 20 times the number of contracts we're going to trade? Well, we have 4,500 contracts here in open interest. So we're pretty good there. Okay. And on the 240, we have 720. So we're good there. Our deltas are in the 20s if you want to add delta to your plan. So we're going to come up here to sell a vertical, and we would get a credit of 345. How much are we risking? We're risking $10 minus 345. So we're risking 655. Okay, so if I say, okay, if I can make 345 and I'm risking 655, am I okay with that? Well, that's a 52% potential return for a trade we would be in for 35 days. So if we're okay with that, we would go ahead, first trigger sequence, we're going to right click, create an opposite order. And if we're saying we want to buy it back when we've got 80% of our max gain. Now, if it was 90%, we'd put in an exit at 34. We're going to put in our exit at 69 cents. So that's 80%. So that's when we have 20% remaining. Going to go to good till canceled, confirm and send. And I'm going to put this in our short put vertical group. So there's our example trade. There's an example trading plan. I hope you have found this helpful. And just keep in mind, this was for example purposes only. I thank you for joining me today. Lots of example trading plans still to come. I'll put a link in to those for you. Have an awesome day. And I'll see you in a webcast coming up soon. Bye for now.